You've heard it a million times. Real estate is the best way to build wealth, but nobody tells you it's also really hard. I've done it. I own multiple rental properties. I've done the flips, hired the contractors, dealt with the nightmare tenants, and evictions. And in this video, I'm going to tell you what it's really like, the good, the bad, and the stuff Instagram gurus won't show you. If you're new here, I'm Bren Brewer, your favorite realtor, and let's get into it. The idea is simple. Buy a property, rent it out, and let the tenant cover your mortgage. Or buy low, fix it up, flip it fast, and make a nice profit. But here's the thing. Between the spreadsheet and reality, there's a whole lot of stress, risk, and unexpected costs. Let's break down some of those most common and most dangerous myths that I hear from first-time investors. The ideas sound good on social media, but in the real world, they can cost you thousands. Myth number one is that real estate investing is passive income. This gets tossed around constantly. Just buy a rental and collect checks every month. Sounds great until something breaks. Last year, I had to replace 2 full AC units in my rental properties here in the Houston area. That's about $12,000 out of my pocket fast. Even though I had a property manager coordinating everything, I still had to approve the work, come up with the funds, and make sure it was handled quickly so my tenants weren't stuck in the heat. And around here, air conditioning isn't optional. It's essential. And repairs like that, no, it's not exactly passive. And guess what? 1 month's rent doesn't cover 2 air conditioning units. So you're stuck coming up with the cash and trying to also pay the mortgage on that property for that month. So it's fun. Myth number two, the tenant will cover the mortgage. This only happens if your numbers are rock solid. And even then, just 1 month of vacancy or one unexpected repair can wipe out your entire year's profit. You've got a budget for repairs, vacancies, management fees, property taxes, insurance, and still make the numbers work. If you're only cash flowing $200 a month and you get hit with a $1,500 repair, that's your entire margin for the next 7 months. Not to mention, some people that I've recently seen have gotten into investment properties and their mortgages are higher right now than they can even get for rent. So myth number three, older homes are better deals. Not necessarily. A lower purchase price often means higher risk, especially when you're dealing with outdated plumbing, outdated wiring, foundations, roofs. If you're thinking of buying a house built before 1980, be prepared for the possibility of expensive upgrades. That deal can turn into a money pit fast. We're talking things that can be in those older homes are cast iron plumbing, aluminum wiring, foundations that are settling or cracking, inefficient HVACs, roofs beyond the useful life, and I've seen some insurance companies require entire breaker boxes to be replaced because they're too old, and roofs to be replaced as well. All right, myth number four. Zillow says it'll rent for $2,000 a month. Feel like I just did a video on that. I'm not a big fan of those estimates. You probably already knew that. But online rent estimates are just that. They are estimates. They don't know the condition of your home, the updates, or that it backs up to a busy road. I've seen investors buy a home expecting a certain rent only to find out they're overpriced by about $300 or $400 a month once it actually hits the market. Always pull those true rental comparisons or ask a local expert before you count on that income. Myth number five, flipping is fast money. I've done flips and I can tell you nothing ever goes exactly to plan. You'll run into delays, price hikes, permit issues, or contractors going silent. The TV shows make it look easy, but every flip I've done had at least one major surprise that ate into the budget or timeline. And if the market shifts while you're still holding that property, you might be stuck with a price cut or worse, a loss. These myths aren't just innocent mistakes. They're the reason new investors get in over their heads. If you treat real estate like a business, not a shortcut, you'll set yourself up to win in the long term. So let's talk some numbers, because this is where a lot of new investors get tripped up. So you've got a property you're planning to rent for about $2,000 a month, and your mortgage, your taxes, and your insurance total $1,200. That leaves $800 in profit, right? Well, not exactly. Let's break it down. So you have your $2,000 a month, $1,200 for mortgage, your taxes, and insurance. Your property management fee is 10% or more, which would be about $200. You've got to average in some for repairs and maintenance, and also for at least 1 month of vacancy, and then your capital expenditures or your long-term savings. So your estimated monthly net cash flow on that is about $233. Once you factor in all of these things, that cushion starts to shrink quick. Your true cash flow is going to be $200 to $250, and that's only if everything goes according to plan. Now, don't get me wrong, cash flowing is great. It adds up over time. But when investors skip the math or assume they'll pocket the full rent, they end up underwater the moment something goes wrong. The difference between a good investment and a bad one, it's almost always in the math. So here are some of the biggest mistakes I see brand new investors make every single day. Number one, buying an older property without a real estate inspection. That house might need $40,000 in upgrades. Get the inspection. Number two, ignoring the school zone. This is going to affect the tenant's demand, and it's also going to affect resale value. Even if you don't have kids, school zones matter. Underestimating the renovation and the maintenance that you need. Always, estimate more, because it's going to be more than you think. Pretty much always. Miscalculating rent potential. Don't rely on your gut. Use the rental comps from a real source. And the last one I see, assuming that it's going to rent instantly. Vacancy is going to equal lost money for you, so be very conservative in your projections. I've personally done this, and I've had rental properties where everything went smooth. I've also had flips where we blew the timeline, spent more than we planned, and had to pivot fast. I've worked with property managers who were great and some who created more work than they saved. I've dealt with evictions, surprise repairs, great tenants, and tough ones. So here's the truth. Real estate investing can absolutely build wealth, but you've got to treat it like a business. So what should you do instead? If you're serious about getting into real estate investing, here's what actually works. Start with a conservative cash flow. Don't rely on Zillow. Don't round up rent, and always overestimate your expenses. If the deal still looks good after that, you're on the right track. Pick properties in strong rental areas with good school zones, stable neighborhoods, and modern systems. Avoid major fixer-uppers unless you have renovation experience or deep pockets. Wholesalers and so-called off-market deals will use urgency tactics to push you into a bad decision. If an investor is willing to pay that price today, they'll be willing to pay it tomorrow. Take your time, run your numbers, and don't sign anything under pressure. Real estate investing isn't easy, but if you go in with your eyes open and your numbers right, it can be profitable. Just don't fall for the hype. If you're thinking about investing or you're unsure where to start, I'd love to help. Visit brenbrewer.com/investing for free resources and guidance. Thanks so much for watching, and if you found this video helpful, be sure to like, subscribe, and stick around for more straight talk on real estate.